The hidden cost of the American dream. 18 million homeowners are drowning in their own houses. 18.3 million homeowners spending unsustainable shares of their income on housing is a genuinely significant figure, roughly equivalent to the combined population of several mid sized states. But the study is built on 2022 census data, while the housing market it's being deployed to explain has shifted substantially since then. Mortgage rates near 7% and a median home price of $394,000 reflect conditions that intensified well after the underlying data was collected. The actual current rate of housing cost burden is almost certainly higher than what this supply captures, not lower, given that affordability has deteriorated on nearly every available metric since 2022. That makes the framing of the number of house poor owner homeowners is falling worth scrutinizing rather than accepting at face value. The Harvard comparison, 19 million in 2023 versus 18.3 million in this study's underlying data, looks like modest improvement on its surface. But comparing figures drawn from different methodologies and different snapshot years to construct a trend line is statistically shaky. It would be more accurate to say the picture is murky and somewhat contradictory than to say house poor homeownership is meaningfully declining, especially while every other affordability indicator referenced in the same article is moving in the opposite direction. The geographic pattern here tells a familiar and important story about how housing costs concentrate wealth based regional inequality. California, Hawaii, and New York topping the list is not surprising, but the scale is striking. California alone accounts for 2.2 million house poor homeowners, with nearly half of those severely cost burdened. That ratio is the detail worth sitting with. When close to half of a state's cost burdened homeowners are spending more than half their income on housing, that is not a population making lifestyle trade offs. That is a population one job loss or a medical bill away from crisis. The economists point that 30% spending isn't automatically distress deserves to be taken seriously rather than waved away, because it's politically correct. A high earner in San Francisco spending 35% of income on housing while still saving aggressively is in a fundamentally different position than a median earner in the same city spending 35% while accumulating credit card debt to cover groceries. The 30% threshold is a useful population level screening tool, but it flattens enormous variation in actual financial vulnerability. The more revealing number in this data is the severely cost burden figure, those spending over half their income on housing, because that threshold leaves far less room for the comfortable despite high spending exception to apply. The low burden states list is its own kind of signal and not necessarily a positive one. West Virginia, Indiana, and Arkansas having the fewest house poor residents partly reflects genuinely lower costs of living, but it also reflects regional economic stagnation, slower wage growth, and in some cases, population decline that keeps housing demand and prices suppressed. Low housing cost burden in a shrinking or low growth economy is not the same achievement as low housing cost burden in a thriving one. The data doesn't distinguish between affordability achieved through prosperity and affordability that exists because an area has fewer economic opportunities pulling prices upward in the first place. The structural story underneath all of this is that home ownership, historically marketed as the foundation of financial stability, is increasingly functioning as a financial strain for a meaningful share of people who already cleared the bar of qualifying for a mortgage. These are not renters locked out of the market entirely. They are people who succeeded in buying a home and are now finding that success itself is financially precarious. That distinction should worry policymakers more than rental affordability data typically does, because it suggests the conventional path to building wealth through home ownership is becoming a path that simultaneously builds equity and erodes monthly financial security for millions of households. The real headline buried in this report isn't the 18.3 million figure, it's that even using data from before rates climbed to current levels and before home prices hit their most recent record, nearly 1 in 5 American homeowners was already financially overextended by their own house. Whatever the current number actually is, it is very unlikely to be better than what this study describes.